Welcome to the Festival of Entrepreneurs, recorded live at the NEC in Birmingham. Over the next few minutes, you'll hear from some of the most incredible founders, investors, and business leaders who joined us this year.
Right, well, up to time. Hello, everybody. Welcome to the Festival of Entrepreneurs. Hello. Oh, good. Some response. Hello. Normally at this point, we're talking about investment. We're talking about VCs. The temptation is to talk about Dragon's Den, but I don't want to do that. This is a festival, so let's think of this as Glastonbury, and let's think of these people as being the rock stars. Actually, your entrepreneurs are the rock stars. This is the Britain's Got Talent panel that we're going to be dealing with. So let me walk along who we have here. First of all, from Haifa, the private equity investor, Isabel O'Keefe. We have the principal from Foresight, one of the most active SME investors in the UK. It's Jerome Sibia. And from Puma Growth Partners, who raise £65 million a year. It is the managing director of Puma Growth Partners, Rupert West. Hello, everybody. So let's kick off, first of all, by saying what many people here are going to want to pitch to investors like you. The question is, and I'm going to run down the line starting with you, Isabel, what makes a pitch stand out? Yeah, you press the button.
Okay. Can people hear me?
That's
Yeah.
on.
Okay, great. Well, thank you, Ian. Just a quick slight correction. So I am an early stage investor from a fund called Mercury VC. So we invest kind of at the earliest stages, typically checks up to 1.5 million into that pre-seed to seed stage. So really looking for the high growth kind of technology driven businesses with a lot of AI underpinning it.
Okay.
So I guess given that we're so early, we really like over index on the team. So kind of finding teams that have domain expertise, a good combination of technical, commercial capabilities across the team is always something we look for. I guess ambition, desire to really go on that venture great scale journey, which usually involves raising a lot of capital, growing kind of 20%, 30% year on year, if not more, and kind of wanting to kind of get the outsized returns for investors. So we, in our due diligence, we really do try to look for that in the founding team and try to kind of really look for signals that these guys can do it. Oftentimes we see founders who have exited businesses before and are going on a journey again, and that's always kind of a positive signal for us.
Mm-hmm.
But more and more today, with the ability to build businesses, obviously leveraging AI, we are seeing more and more people that are first-time founders that are kind of building businesses from scratch, scaling pretty quickly. So it's an exciting time.
Okay, you've raised the spectre of AI already. So my question: what makes a pitch stand out to you? Is AI part of what you like in a pitch? Oh, we can't hear you. Once the red light is on,
Fine.
it's awkward because you can hear us and we cannot hear ourselves. So, Isabel.
Yeah, I think
Carry on.
like we can probably have a discussion about this because, from we're a specific investor, so we are looking for technology AI driven businesses. So for us, it's becoming a little bit table stakes to see that most businesses that we're seeing are coming that we just assume that they're either AI native businesses or they're using a lot of AI across their processes to automate and like obviously create efficiencies across the businesses. So I think we're going to move into, particularly at the early stage, AI investing, that we're going to see more and more. It won't be necessarily needed to say, oh, it's an AI business because it will become more AI native. But that's, again, specific to the areas that I'm investing into out of the fund I'm investing. So be very keen to hear these guys' opinion as well.
Okay, Jerome, I'd be interested, first of all, to find out how many pitches you actually do have to sit through. So that's my first question. How many pitches would you say?
On an annual basis, we look at about 2,000 pitches a year.
2,000 pitches. So which are the ones that
We
stand out?
completed 26 new investments last year, so it's just over 1%
Okay.
complete. In terms of what stands out for us, so as a firm, we have two sort of core strategies, so growth capital and buyouts. On the growth capital side, we look for three real things. One, evidence of product market fit. I'm afraid that we use kind of a bit of a crude proxy for product market fit. And we say, once you've got to 1 million of ARR, if you're a software company, so it's annual recurring revenue, or 2 million of revenue for a regular business. So about 40% of the investments we make are in technology businesses, but the rest are in very old world businesses. So, for example, here in Birmingham, we own a business called Roxy, which is a chain of table tennis bars and social gaming, right through to holding something like RuleGuard, which is a software compliance business and has an ARR recurring revenue type model. So early evidence of product market fit is one. The second is domain edge. Do the founders have a right to be playing in the space they're in? If I'm a plumber by trade, should I be setting up a rocket business? Probably not. Equally, if I'm a builder and I'm going to launch it, or a plumber and I'm going to launch a new plumbing business, maybe that's something we can back. So we look at both old world as well as new world businesses. And the third is a large and growing end market. If you take share in that market, is it large enough to give us an outcome where we can return 3, 4, 5 times our money, which ultimately is our objective of our funds? So those are the three things: product market fit, domain edge, and large and growing end market.
Lovely, thank you. And Rupert, what about you?
I don't have a button. Can everyone hear?
You're on. You're
Good.
on.
Very good. So I couldn't hear any of the first answer, so I hope this doesn't completely repeat it. To try and get a little less sort of investor-centric and talk about, I mean, lots of things like we've just heard, they're very, very sensible. This is what that fund looks like. But in terms of you going and trying to stand out, I'd actually really caution, don't try and stand out. Try to be yourself and try to fund an investor who is looking for what you do. I would say share the facts in advance, right? So people will look for certain metrics, so certain revenue levels, certain background about yourself, in a pretty strong way. Like, don't waste your pitch time conveying that information. Send that in a deck. Make sure the deck like actually says what the business does. You would be amazed how many times as an investor you're sitting there going, well, I don't really know what these people do, and I've looked at their website and that doesn't really say what they do, so that one's in the bin, right? But get that stuff in advance, and then in the meeting try to express yourself, your personality, and the culture of the business and what you're trying to do with it. And then really it's like a job interview or a sort of school assessment or something. You're looking for them to be looking for you. You are looking for an investor who does the kind of thing that you do and therefore is best positioned to help you, and has the sort of infrastructure and tools and interest and appetite to work with businesses like yours. Bit vague, but I think that's...
No, but it's a really good point, isn't it? Do you try and make your pitch suitable for the person you're pitching to, or do you try and find the right person out there that would be right for your business? Which way round should it go, in your opinion?
I think you should never contort your business for an investor. You should try to find businesses that are similar to yours and see who invested into them. And then you can talk to those people and say, well, what's that investor like? And have they been able to deliver the support that they sort of said that they would? And then go and approach them and say, look, this is my business. Is this the kind of thing you're interested in? And similarly to you being clear about what your business does, hopefully funds and investors, when you look at their collateral, they will set out relatively clearly who it is they're looking for, what it is they try to do and want to work with, and you can see if you fit.
I'm interested as well in this moment of valuation, where obviously as the founder you want the valuation to be as high as possible. Is it your job to make sure the valuation is as low as possible? Jerome, you're looking particularly pained by that question, so I'll come to you first.
It's a very difficult one to answer. We're in a world where raising money at high valuations is very sexy. It gives you lots of clout and engagement on LinkedIn or a nice article in TechCrunch. But very often those businesses that raise at high valuations from investors who give them that high number actually come with some very important caveats. So one, there'll be lots of structure around those things. So investors will want preference shares, they will want preferred returns. There might be multiples of preferred return. So you may have a business that raises at a high number, sells at a number that's lower than the number at which they raised, and walk away with effectively nothing. So I often caution founders to be careful about the type of money they raise and the structure of that money. So I think that's one point. The second point is very much around the exit velocity. If you're going to raise at a higher number, you need to sell an even higher number for everyone to be in the money. So be be reasonable about the exit multiples you're able to achieve and work backwards as well before you go out for a big number. And I think the third bit of that is really around the amount of capital you need. So to raise at a high valuation, often that leads to slightly a larger check to be a meaningful, for the investor to be a meaningful number on your cap table. And so suddenly you're then taking, say, for example, £5 million at a 15 million pre-money, 20 million post. That then almost encourages you to burn that £5 million in a short space of time to go on to your next milestone. When often I think some of the businesses that are most enduring are ones that can raise relatively small amounts of money and only really raise bigger when they need to, when they've got real evidence of channels in which they can deploy it well with a good ROI.
Right. Isabel and Rupert are both nodding all the way through that, and I hate to see a panel that agrees too much. But Isabel, you're going to jump in.
Yeah, I think like look, I agree with majority of those points. And maybe just from a more practical point of view for founders in the audience, because I've seen it happen a lot of times. Founders do tend to over-index on dilution at the early stages, and often with a view to saying, I believe my business is worth this. I'm not willing to kind of take investors on board if they don't believe that too. But sometimes what we see is if you over-index at the outset on the valuation or dilution and you don't take the right investors, you take the wrong investors. And often you'll end up having to raise additional capital further down the tracks, taking more dilution in the end anyway. So if you think about the end goal and wanting to own X percent of your business with a big outcome, it's much better than owning, a huge percent of the business with a very low value outcome. So it's just really like thinking about it in the long term and not kind of over fixating on some of the short termism that can take over in that decision making process.
And Rupert, what about you? How do you negotiate that moment of valuation and dilution?
Firstly, I think this is all exactly right, and it's really about this. Where you are best positioned is to have harmony between yourself and your investors, all of them who've come in multiple rounds, so that everyone is able to feel they're doing well, because that really leads to everyone leaning in and driving in the same direction. And just to this point around structure is absolutely true, and the rest of the points we heard, if you negotiate super hard and bring your investors in at a higher valuation than really they're comfortable with, they're sort of always a little pissed off, but they're also they're nervous, right? And if things don't then go incredibly to plan, there is a risk, depending potentially on the individual investor, but there is definitely a risk that they feel alienated from this investment. They feel they're not going to make any money and they put their efforts elsewhere. And then you've massively shot yourself in the foot by doing that for, a few extra percent of ownership of something that's now not going to grow anything like as much as it could have done. So I think to the point we've heard before, valuation and dilution are dynamics of how far do you ultimately think you're going to get, and which of the potential investors who you could bring on board can help you get there the fastest, with the highest probability of success, with the lowest risk of failure, all of that sort of balance of things. And don't really over fixate on your dilution today, fixate on what your end point could be and how you're actually going to get there.
Okay, thank you very much. We know there's lots of different types of investors. There's the angels. I'm interested in the family offices, because those are quite popular with SMEs and with founders. So, Jerome, what's one thing that family offices care about that VCs otherwise often don't?
It's actually a great question. So I previously worked for a family office for 2 years, a firm called Literacy Capital. And it's a listed investment trust, but a family office at heart. What you see in family offices is typically faster decision making. So in my current firm, we have 2 sets of investment committees that we need to get through approvals, and that takes a period of time, and I need to write papers and submissions, whilst in the family office, oftentimes over WhatsApp, we can agree the outlines of a term, the outlines of a term sheet rather. So that's one thing. So speed is what a family office can give you. Sometimes domain edge as well. So if the founder or the person who's running the family office has particular expertise in a certain sector, that's often helpful, because they will be more orientated around the types of businesses that they previously had experience of. They'll have a great network of potential non-executive directors or potential operating executives they may well be able to bring into the team. And I guess third is timelines. If a family office is investing out of evergreen capital, so their own money they don't need to return in a fixed period of time, they may well have a longer investment horizon. However, there's also downsides to family offices, and one of them may be that they may be less forthcoming in giving follow-on funding because they may have all their capital deployed at that moment in time, whilst a fund may be doing multiple role. I mean, you raised £65 million last year, as an example at Puma, and so you have new pots of cash to go and deploy into companies, which you don't necessarily have in a family office if they're waiting on a realization or something from the portfolio. I think that's some of the positives and some of the downsides as well.
Okay. Isabel, let's just have a quick recap on what VCs otherwise are looking for.
Okay. So there's obviously different stages that VCs invest. So you go from kind of early stage, so pre-seed up to like Series B plus. I guess there is universal things that VCs are looking across the board, but tends to be some form of high growth businesses, usually tech businesses that they see kind of high gross margins, 80% plus for B2B SaaS in particular. They're looking for founders who, as I said, are pretty ambitious, or know the kind of, I guess, pros and cons of taking on venture money. To the points made earlier, there is a lot of kind of things that come with it. You have to be seen to want to raise 3x the capital every 18 to 24 months. You have to kind of increase the valuation at that kind of that rate as well. So, and with the kind of idea that you will exit for upwards of 500 million to a billion. So VCs are looking for $1 billion markets. That's how we make money. Our funds are structured though so that we usually have a 10-year fund cycle. So we will invest the first kind of 4 to 5 years of the deployment period, and then we want to start to see exits between kind of 4 to 6. Okay, the markets are a little bit different at the moment given the liquidity issues, but we do see that as the key horizon for exiting businesses. And we will work on a bit of a parallel. So we will say we do 30 investments across our fund. 3 or 4 of those deals will return our entire fund. So we need to be looking for deals that we believe can be those outliers. And so that basically they're some of the kind of key indicators we're looking for. So again, when we're assessing it, we are really looking for like the founders who are willing to go that extra mile, who want to scale their businesses, usually obviously from the UK to the US, but are able to attract really good talent, can kind of really be capital efficient. Actually is becoming more and more the thing VCs are looking for across when they invest into the businesses. And to the points earlier, like being a bit more cognizant of the valuations and kind of the market and, how hot it is at the moment versus kind of what's realistic.
Okay. I'd like to throw a question out to the audience right now. So first of all, put your hands in the air. I'm going to ask you a question. We'll see if we have time for you to ask me a question shortly. So if you put your hands in the air for me, please. If you could just put your hand in the air. Put your hand in the air. Lovely, thank you. Put your hand in the air, and then I'll come and ask you a question. Right, and keep your hand in the air if you are going to be seeking some kind of VC investment for your business. Keep your hand in the air. Right, and also keep your hand up. So if you have done this before. Right, so you've all sought VC investment before and have been successful. No, from VC. So hand down. Right. So that gives us just a couple of hands up. 1, 2, 3, 4. Okay. So my question to the panel, based on this, so it does seem that we're working with people who've maybe not gone down this road before. So beyond capital, what support would you give to founders? And I'll start with you, Rupert.
So the ethos of our fund comes from our journey of setting it up. So Puma Growth Partners is part of Puma Capital Group, which 5 of us set up 12 years ago. We're now at 145 people, £1 billion of AUM, 40 plus million of revenue, offices in London and Edinburgh and Manchester. So we've been on the journey and made the mistakes and had the sort of joys and concerns. And we just sort of mainline that into the companies that we back. We effectively tried to condense, 12 years of experience into a kind of structured set of learnings that we can give to them. And we do that by having a pretty big team. So we really invest our own kind of profit into our portfolio team. And we have in-house lawyers and in-house HR people and in-house go-to-market experts, in-house strategy people from big consultancies. And we kind of give all of that to the companies we back, we give it as support, as part of the relationship, as part of the nature. So we work with Series A firms. We invest 4 to 10 million pounds per round. So there's quite a lot there. The average revenue of the companies we get involved with is sort of 7-ish million pounds, although there is a bit of a range. But so there's some data there, there's some people, there's some nuts and bolts for us to get to work with. And it's actually, just to come back to my earliest points around fit, if we saw something that was kind of really exciting, that was pre-seed stage, super early, we actually wouldn't be able to bring to bear all of that infrastructure that we've put together. There wouldn't be the data that we normally work on in this business. So we wouldn't actually really be the best party to help. That, which, just to sort of undermine that point, you shouldn't go as big as you can, because those people are used to dealing with bigger businesses. Get someone who's used to dealing with the stage you're at. But that's really our approach and how we go about it.
I do always like the euphemism of experience for mistakes. So fond of that. What about you, Jerome? What support do you give to founders?
So our heritage is more on the private equity side rather than on the venture side. And so, bearing that in mind, we often historically have been investing in established businesses that have good evidence of product market fit and have a clear growth plan and generally have a path to profitability or are already profitable, because that's our heritage in private equity. That's where we start. So we're slightly more hands off in how we engage with our growth assets. So we are more helping you identify the right chair. So oftentimes that's a core kind of rocket boost to the business, taking their learned experiences from a larger business and applying it to a smaller company in a similar space. So finding that chair is one. Two is helping bring some financial discipline to the forecasting and to operations. So helping appoint an FD is often something that will help do. But then beyond that, we have a wide portfolio. We have 250 companies in it today. We have lots of learnings and shared experiences from that portfolio, but we're not as operationally involved as someone like Puma. So I think that's kind of one of the differences. We let the executives of the business manage the business, and we support them along the way. Where we do add most value is probably the ability to provide follow-on funding. So last year, we completed 26 new investments on the platform side, but then 49 follow-on funding rounds to support a business as it goes through its growth journey, whether that's to invest in sales and marketing, open a new market, acquire a competitor, whatever it may be. We can support that capital. So I think there's different firms that offer different things, different stages of a business.
Thank you. And Isabel?
Yeah. So as I mentioned, we're the kind of earliest investor in, and we do take a very hands-on approach in terms of what we can do and where, to the points earlier, where our skill sets are. So largely, we look to kind of like Mercury, the fund I'm working at the moment. We have a thesis around the media space, so we have a lot of connectivity with the big publishers like News Corp, Scott Trust, The Guardian, and we have kind of big corporate relationships. So what we do when we invest is, given that we're investing on our thesis, we have the ability to introduce those founders and those companies to those folks for either design partnerships, which are quite crucial at the early stages, potential pilot customers, and even just advisory boards. So that's a big thing that we just have in our wheelhouse that we can wheel out straight away. We often take a board seat or a director role on the company, and it's at that point it's a very small board. So we do help with decisions around hiring. So at that point, like, there's usually not a CFO or an FD in the business. So we're largely involved in helping with the modeling of the financial forecast, the milestone setting, and then figuring out what the hiring plan should look alongside that. So that's usually set in or on the time that we do invest. And then outside of that, as the company kind of hits those milestones and moves on to the next stages, we do get involved in bringing in the next best investors onto the cap table that we think we can provide. So we pride ourselves on building relationships with investors upstream from us, so that at the point at which you're ready to raise money, we're ready to kind of introduce you to the right investors for that next stage, who largely we kind of hand over the reins to them at that point for them to kind of bring in the skill sets that they have. But what you will see, like across the board in venture in the early stage, you will see the seed investors do tend to remain very involved in the businesses throughout the journey, because effectively, while we're taking preferred equity, usually we're still very kind of core to the founding team, and we've built that relationship early on, and we've kind of seen, oftentimes we invest, and the first board meeting afterwards, a lot of things are not what we thought we were investing into. So we're kind of on that journey with you, and I guess our interests are quite aligned as well in terms of the kind of ownership structures and the scaling of the business. So yeah, so that's kind of from the early stage. So I guess maybe from a practical insight, like picking your early stage investors is so integral to the journey that you go on. So I think, yeah.
Okay, thank you very much indeed to my panel. We have Rupert West, we have Jerome Sibia, and we have Isabel O'Keefe. Thank you very much.
Thanks for watching this special episode from the Festival of Entrepreneurs. Our mission is simple: to help founders and business owners grow faster, think bigger, and take action. And if you were part of the event, thank you for joining us and being part of the community. And if you missed it, don't worry. We'll be back with even more ideas, inspiration, and opportunities to help you take your business to the next level. You can find out more and register for future events at festivalofentrepreneurs.co.uk.